Hi, good morning. Today I'm going to cover a topic on equity savings fund and money market fund. Let me share you what we are going to talk today. Uh, Equity savings and money market fund helps you to deploy money in the short term. So, so let me cover about each category. These two are different categories in the mutual fund categorization. These two are different categories in simple words. So money market funds have commercial papers and certificate of deposits which matures within 1 year. Basically, commercial papers and certificate of deposit for short term in nature. It's basically like you must be knowing what a bond is. So it's basically a short term bond type of bond. Commercial papers and certificate of deposits are issued by corporates and banks and non-banking financial companies, basically. So these papers, since its basic nature is maturing within 1 year or within a short period, money market fund as such in the mutual fund category invests in papers which are maturing within 1 year. So if your timeline, if your goal is within 1 year, or an year's time and a year and a half, you can consider money market funds as such. Since it is 100% debt or a fixed income fund, you have compare in relative to equity markets wherein it is volatile in nature in general. But in these type of funds, in debt funds and fixed income funds, that too, which is maturing in a shorter period, you have very less probability of making losses in these funds. Again, I'm not telling you it's a zero risk fund. It is not capital guaranteed, and as well as it has risk, but historically, if you see, it had very less drawdowns or very less negative events happening in these type of funds. So when you are considering for a period of 1.5 years, and the timeline of the papers lying in the particular fund, the commercial papers and certificate of deposits matures within 1 year. So if your timeline is 1 year and 1.5 years, you can consider money market funds out of the mutual fund category as such. And next I'm going to cover about equity savings fund. Equity savings fund is nothing but a combination of arbitrage plus equity plus debt or fixed income instruments. Arbitrage is nothing but you are buying and selling an equity, a script at the same time, a stock at the same time. You're buying and selling a stock at the same time. So the average value out of this action is your result. Historically and generally, if you see, arbitrage as such has an average component in it, and chances of losing money is little less here. And equity as such comes with a risk, but in equity savings fund, you are going to have a measured equity allocation. So again, you are investing in equity, you are getting the benefits of equity, but in a measured way. So you can consider this as a part of your short-term deployment. And again, debt as such, debt or fixed instruments as such, has a predictive cash flow component in it. So a combination of these three could give you a little better returns than inflation, and it can protect, or it can protect the drawdown compared to a pure equity instrument, pure equity fund. It is way better than a pure equity fund. And when you do it as a combination, when these two type of funds are combined together, maybe it depends upon your timeline, and it depends upon your comfort of taking risk. But generally, combining these two funds put together may be good for your short-term parking of funds for 1 to 1.5 years. So money market we have covered in this video, and equity savings we have covered in this video, and these two can be combined for short-term parking for 1 to 1.5 years. and even you can prolong it to more than 1 to 1.5 years also, wherein you can use these combination as a cash position, especially money market funds. This you can use it as a cash position, and you can deploy this in opportune times in equity markets. Like the opportune times may be a bear market, wherein the overall valuation would be visible in the market, or you may see a value in a particular sector. Entire stock market may be up, but a particular sector or an industry may be in a value, it wouldn't have run up like other sectors or hot sectors. Maybe you could, if you could able to find a value in a particular sector, you can use cash positions of money market funds. You can treat it as a cash position, and you can use it at the right time when opportune times are present in the equity markets, like a bear market, or if you could find a value in a particular sector, you can use it as a cash positions. Yeah. And finally, if you are spending 10,000 rupees out of your pocket, hypothetically, if you're spending 10,000 rupees out of your pocket, what happens? It is not only a 10,000 debit, 10,000 rupees debit from your balance sheet or P&L, it is a 10,000 rupees debit, or you have exhausted an investment opportunity worth of 10,000 rupees. You can see it that way also. And with an inflation, if you factor this, you would have, if assuming 7% inflation, you would have had an inflation effect of 10,700 rupees on the 10,000 rupees which you have spent out of your pocket or wallet. So rather than spending 10,000 rupees out of your pocket, why can't you invest in these combinations like equity savings and money market funds and create that 700 rupees or create that 10,000 rupees as a capital gain? You may create 10,700 if you are withdrawing principal plus interest. Considering an example of 1 lakh or 2 lakhs of your investment, you may withdraw only the interest amount of 10,000 rupees. The choice is yours actually. Either of the ways, you can explore money market fund and equity savings fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully. Thanks a lot.